The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Mridul Mishra from the corporate communication team, and on behalf of K Ratings, welcome you to our today's discussion on microfinance sector and sincerely appreciate your time in joining us for this webinar. We are indeed fortunate to assemble our esteemed speakers for today. Dear ma'am and sirs, thank you and welcome. Dear participants, we'll be having a Q&A session at the end of the panel discussion. In case of any queries, you are please requested to key in your questions. There's also a raise your hand option which you can click once the discussions are over. Now may I invite Mr. T.N. Arun Kumar, Executive Director and Chief Ratings Officer at Care Ratings, who will be moderating this session. Mr. Arun Kumar has over 28 years of experience in credit rating and project appraisal. He has done his post-graduation in management from Indian Institute of Management, Ahmedabad, and his agricultural engineering from IIT Kharagpur. May I request Mr. Arun Kumar to take over the proceedings, please?
Yeah, thanks, Madhul, and hello, everyone. Very good afternoon to all of you. I heartily welcome all the panelists today, and I think we have a very interesting topic to discuss, and we'll just introduce the panelists first. First is Deepti, who's the head of policy of Dvara Research, and the other details are broadly explained here. She's been there with them, and this is Dr. Gauri Shankar. Thanks for joining us, Dr. Gauri Shankar. Is the MD of Maanaveeya Development and Finance, and Mr. Manoj Nambiar is also has been a dual role, probably one as a from the Nbfc point of view, another is from the SRO point of view, because he's been on the governing board of MFIN since 2013. So I'll start with a small overview of the sector and the kind of snapshot of what we see in a broad level, and then we'll go to specific dimensions of what the viewpoint of various participants in the sector. One from the borrower's perspective, then we'll go to the investor's perspective, and then we'll go to the MFI perspective. So can we go to the next slide? We'll start with my small presentation. Ravi, can you start the slideshow?
Yes, sir.
Yeah. Not able to see, Ravi, not able to see that presentation. Yeah. Yeah. Post, I mean, is it the first slide? Yeah. The CARE has got, as a rating agency, has got a wide coverage of NBFCs in the sector. In terms of the sector, post demon, the sector is now back on track in terms of growth, with loan portfolio increasing from 1 lakh crore as on March 17 to 2 lakh crore as on March 20. There's been a change in market share of various players. Banks, which had a share of 37%, they've increased to 40% on account of Bharat Financial Inclusion merger in IndusInd Bank. The share of NBFCs has reduced partly because of this Bharat Financial merger, and partly because of this creation of a lot of SFBs in the system. In terms of other NBFCs, the share also has gone up because of a larger focus, and also within they can operate within a cap of 10% of their total assets. And as I mentioned, CARE has a large coverage of 24 NBFC MFIs out of 96 registered with RBI, and 51% of the AUM in terms of the amount of AUM in NBFC MFIs. And CARE has a coverage of 6 small finance banks out of 10 which are registered with RBI. Next slide. Yeah, in terms of this, gives a brief snapshot of financial performance, since the last 4 or 5 years. In terms of portfolio, as I mentioned, there's a good portfolio, but you can see a small moderation in FY20, especially in the last quarter, in the last month, due to obvious reasons. And it is expected to continue this moderate performance even in FY21. We don't see too much of a growth, and with negligible disbursements in Q1, especially what we have seen, and some more time required for stabilization for the MFIs. Profitability is also moderated, with increase in credit costs on account of increase in provisions, mainly due to COVID, ROTA has also come down from 4.33 in previous year, FY19, to 3.63 in FY20, mainly because of increase in credit costs. ROTA is also expected to be impacted further if there is no substantial improvement in the collection efficiency from now. And MFIs have been maintaining adequate liquidity as we can see always. But continuing moratorium has definitely affected their liquidity. Of course, this liquidity measures announced by the Government of India is likely to help these MFIs. In terms of the gearing, it has been improving with the equity infusion from the promoters post demand. There's been a lot of investor confidence in the sector. And as on March 20, the average gearing stood at around 3.5. The current gearing levels are expected to take the impact of credit costs nevertheless in the near term, what we see. Next slide. In terms of collection efficiencies, as we know, prior to COVID being above 90 plus levels, in March 20, government imposed lockdown and it put restrictions on movement of people and stoppage of business, including the borrowers of MFIs, including MFIs also. RBI also announced moratorium provided by lenders, including MFIs. MFIs had to necessarily provide moratorium to the borrowers, and this is one of the sectors where we would have seen the largest percentage of assets under moratorium. This led to, believably sharp reduction in collection efficiencies, with negligible collection in April 20. After that, there has been a gradual improvement, and in July it hovered around 70%. But it's yet to reach obviously the normal levels of 90 prior to COVID. Here expect that there'll be write-off in the portfolio considering past experiences, which is expected to be cushioned by further equity infusion by the promoters. Collection efficiency of MFIs in some of the regions got impacted more on account of continuing lockdown. Especially we see some districts in Maharashtra and Tamil Nadu and Kerala. These states also continue to be highest impacted in terms of the infected persons of COVID. As a concluding slide for me, Ravi, can we go to the next slide? Resource mobilization wise, NBFCs, including MFIs, have faced severe constraints in resource mobilization post announcement of the moratorium, which was not very clear whether it is applicable to NBFCs or not on a blanket basis. The lenders also were obviously cautious towards fresh sanctions in the sector because of expectation of deterioration in asset quality of this vulnerable sector. In order to create liquidity measures, RBI and government have announced a series of measures, including TLTRO, as we know, and partial guarantee schemes. There are some modifications in the scheme to cater to lower rated entities during the course of time. With support from RBI, Government of India, MFIs have started to mobilize funds, and it is, it's surprising to see there were no primary issuances of MFIs in April and May 20. And from June onwards, they were able to garner funds to a total of around 2,000 crores by around 12 NBFCs during this period, June to August, with a positive inclination of higher mobilization during the subsequent period. So there has been a confidence building in the sector with increasing availability of funds, which is a positive factor today. Now coming to, I would be shortly handing it over to Deepti to start her presentation. Would be on a study undertaken by Dvara on borrowers profile especially, and we'll shortly go there. I'll hand over the mic to Deepti to take it over from here.
Thank you, Arun. I hope I'm audible.
Yes.
Okay, great. Okay, so I'll just quickly talk through some of the, I wouldn't call it dipstick, but really a quick sample survey that was run by the Social Protection Initiative, and maybe just give perspectives from the ground about what were the results. So next slide, please. Yeah, so that's really the perspectives from households, and the survey is called the COVID-19 Impact on Daily Life Survey, which is done by the Social Protection Initiative, which is a practice within Dvara Research, which is interested in kind of having a universal, or rather it's a policy initiative working towards having a universal social protection, I would say, regime for Indians, and that means being much better able to manage vulnerabilities and threats as part of their life cycle, right? So there was a whole gamut of questions around kind of the government schemes, etc. So I won't go into that, but really just talk about how did households cope with the lockdown, and how do they manage, right? So that's really what I'd cover. And then quickly, I'll also talk about some perspectives we received from credit providers, and themes that we are hoping to kind of continue explore as these days actually play out, right? Okay, next slide, please. So quickly, the survey was in coordination with 12 last mile financial services providers. I think the sample was around 347. 3 rounds were done so far. And I think, and this was across 47 districts, which kind of spread across 9 states. There were 3 broad questions that were asked. What are the signs of distress, right? What could we ascribe as signs of distress that households experienced? How do they cope with the situation? Did households have access to essential services, namely, banking, ATM, essential consumption, food, all of that? And third, were households able to avail benefits of government welfare schemes, a whole bunch of which were announced as part of the Atmanirbhar scheme, as well as additional schemes which were already in place. So just if you see, it's actually a very high frequency study. It tracks the set of households every 2 weeks. And you can see the kind of the timelines, right? It was April to May, and then May to May, and then June to July kind of a span. Next slide, please. So the sample was really to say we obtained kind of interested partner institutions. They were free to choose, 5 villages randomly selected, and then kind of 5 households per village, plus additional in order to take care of any attrition. And as much as possible, some diversity in terms of the households itself, the socioeconomic kind of characteristics, right? And it was administered through the phone, so therefore it obviously selected households which had at least one mobile phone that was accessible. Quickly, I just want to say what are the limitations of the study. One is that there is no baseline. What's the normal non-lockdown situation number looking like versus what we saw in lockdown? But it just gives a sense of how households, what their immediate responses were. It does not cover or ask questions on loan repayment behavior, simply because it's an MFI who is actually helping us to administer this survey. So it wouldn't make sense to ask. If a question is asked through the MFI, then that's not, sorry, when I say MFI, the organization in place, that would be unfair. And it will kind of change the responses that you obtain. It also does not capture local, economic factors like swings in commodity prices or the volatility in wage itself in the region as a result of lockdown. And it's certainly the study is not representative of what's happening in the nation. But obviously there are a whole bunch of other studies which are happening, which when we bring all of these together, we can get a good sense of what's the underlying kind of behavior, right, of households. And then we had some checks and balances to ensure that we don't have people are not coerced into specific answers. So broadly, this is just round 1, round 2, and round 3. We had a significant rural sample of around 80%, and it spanned across these kind of states. It had a good mix of, I would say, occupation. So there was farming, wages, self-employed, which is skill-based, self-employed, trade, and salaried. Next slide, please. Yeah, so quickly, these are really just the list of essential services. The observation was that, so if you look at the first few kind of bar charts, these are really essentials like food, fresh food, medicines, the Kirana store, ration shop, ATMs, your BC outlets, whether these were available or not. So clearly we see that there's an increasing trend. There was obviously a drop, but then we don't know to what extent the drop was when the lockdown was announced. And then there was an increasing trend of access to all of these services. Transportation actually had, fairly been inaccessible, and that's again picked up fairly well by the 3rd round. Next slide. Going to household coping mechanisms. So when we looked at the various occupation types, it was very clear, and this is also corroborated from kind of others on the ground, that agriculture, so really the farmers and all those kind of people engaged in agri and allied services, actually for them, the bounce back was much more faster and much more better, versus, let's say, what are typically characterized as self-employed, so skilled workers or running petty shops or petty trades. These people had a lot more difficulty and they continue to struggle. As you can see, this is really just the percentage of people who are engaged in work during lockdown. Next slide. And we also saw, so if you see the first panel, that's really again people who actually were engaged in income generating activity, and also people who have also started looking for work and were not able to get it. So there again is like by around 60% were already engaged in an income generating activity. About 70% of the respondents who actually responded were actually in the same job as they were before the lockdown. However, there was a slight dip in the wages that they received as before the lockdown. So I think around 45% said that 45% of who are actually engaged in an activity said that we are receiving slightly less wages as compared to before the lockdown. Next slide, please. Did households actually reach out to MNREGA for additional work and income? It didn't seem like a very significant factor. Also, since we don't have controls, we don't know what the usual number is, and so broadly we could say about 10% of the total sample actually asked for and obtained MNREGA work, and a median number was about 12 working days which were obtained. And when I say 12, it's really work that got allocated, because the moment you apply for work and you're informed, you also get a sense of how many days of work has been allocated to you. So that gives you a sense of how many days were available for earning income through MNREGA. But it doesn't seem like it was extensively used by the households that we were asking. Now, distress, right? So the study actually looked at 4 signs of distress. It didn't go beyond that. One is, did you or any member of the family miss medicines or hospital visits? Did you miss food at least once? Did you have insufficient talk time? So you were in at least one phone, right? Like, and also did you not have an active data pack? So clearly there were some trends to say, while 12% missed hospital visits, the number was slightly higher, but it seems to be stable. There is an observable reduction in essential consumption at the beginning of the lockdown, but that's also improved as the lockdown progressed. Unfortunately we didn't ask, there are a whole bunch of other signs of distress, right? Like you could say distress sale. In fact, asset sales have been captured, but in another category. Please, next slide, please.
Can I interrupt Deepti just a minute?
Yeah.
Can you go back, Ravi?
Yeah.
I don't see any trend here. I mean, it's all the same across the rounds of all 3 rounds of this thing. It's generally stable.
Yeah, it's not significant. It's not significant. I think just on the missed food bit, there was a slight. We don't know what the control was, right? Like that's the thing. We don't know what the situation was before lockdown. But it was certainly something that people stated as having experienced. But it's probably, we can't describe a significance level to this. So I agree. So there are no big jumps or trends. So that's I agree. Next slide, please. So typically, so this is very interesting. So if you see on the left, this is really just the detailed set of sources of funds that households had access to, right? So there's really cash at home, withdrawal from bank, government in-kind transfer, government cash transfers, salary or wages for work done, sold assets, so durable assets and livestock and other things. And so that's really the set of money, so really funds coming in from what you could describe as income, right? And then you have access to informal loans. Did you take a new informal loan with interest, friends and family? Did you take a new loan from a financial institution? Remittances, so reliance on remittances from friends. Did you then a set of questions on how much did you rely on the employer for new work, for collecting arrears which were anyway ascribable to you? Did you ask for more work? Did you ask for different work because existing work was not available? So some of those questions. And clearly what is interesting here is if you see the top 2, the immediate response was to obviously say, okay, we just used up the cash at home and then we had to withdraw from our bank account. But soon, if you see kind of informal loans with interest, that has actually slightly climbed up across the first, second, and the third round. So is the case. So on the right panel is really just a summary of all of this. So we've clubbed all these categories together, and we see that income seems to be kind of creeping up. But here, income as the main source of cash flow is creeping up. But It also includes things like sale of assets, sale of livestock. So there are a couple of instances where households have resorted to these things. I think there's anecdotal kind of examples where in Tamil Nadu, people just decide, just because milk prices crashed, they just decided it wasn't worth it to keep dairy, and so they actually just sold cattle, their heads of cattle. So those kinds of examples are there. Borrowing, both formal and informal, seems to be slightly increasing, and the others are all negligible, like reliance on employer, reliance on cash and in-kind, funds from NGOs or village level organizations, so on and so forth. Next slide, please. Yeah. Now, again, I would say take this with a pinch of salt, but really this is just analysis of what is the median amount, right, that people resorted to obtaining, or people obtained across all of these kind of sources. When you see, what's interesting is, I would say, the fact that there were a couple of instances. So whatever number is in the bracket is really just the percentage of instances from respondents. So it's actually fairly low when it comes to, say, taking the new bank loan from SFG. We believe maybe there's an interpretation issue. It could also just be intra-group borrowing or lending that's happening. Need not necessarily be actually borrowing from a bank. New informal loans with interest, that's actually significantly increasing, right? Like, so, and a median amount of 6,000 rupees being borrowed from informal sources. The sale of durable assets, again, very infrequently resorted to, but there are instances of these. But really, access, withdrawing money from banks, salary or wages from work done, these seem to be the kind of the top kind of ways in which people actually coped, and the direction, or rather the sources of funds that households actually had. Yeah, so I think the last entry is really just the government cash transfer, with the median amount being around 1,350, because different states had different schemes being announced. Some of them were already there, some of them, and different states have different, I would say, success rates in terms of actually having disbursed the money. So, across all of this, but I mean, the SBI initiative did conclude that when they did an estimation of if the household were to have received at least one round of all of those schemes that they're eligible to, that number should be slightly higher. So it just means that the 1,350 rupees didn't cover actually all of the money that should have come to the household, and so there's some more gap there to be filled. Next slide, please. Yeah, so I think just summarizing, initially there was a high rate of unemployment, and then members started getting back to work. There was at least 45% reported a significant reduction in the earnings. Although the reduction itself, we don't know to what extent that is. We can't clearly kind of pinpoint. There is a difference between rural and urban households, and I think this is corroborated from conversations with practitioners also. Rural economies seem to be bouncing back much faster, whereas self-employed occupations continue to struggle. Income gains, again, has started becoming prominent, but there's also there is an increasing reliance on informal safety nets. And when I say safety nets here, this includes informal borrowings. There's a reduction in consumption initially, from at least for essential expenses. But again, like Mr. Arun pointed out, this is not, it's not such a significant number to kind of worry about. And access to essential services have continued to improve. Transport services have picked up. Next slide, please. Yeah, and then so far we don't talk of moratorium, right? But then we know that I thought I'll also spend just a minute just talking about moratorium and the announcement, and how RBI made it very clear that the moratorium should not result in an asset classification downgrade, and bureau should be should ensure that that this does not adversely impact borrowers' credit history. So we did speak to a couple of practitioners, and that work is ongoing. But what we found, I thought I'll just share. I think the initial, and of course, we have practitioners here, Manoj, I'm sure you'll be able to contribute to these discussions. But really, initially when it was announced, it was in many instances declared as a blanket moratorium. But over time, that changed to making moratorium into an exception, because and it also, and I think the strategy was to say, okay, fine, we just have to make sure that the information about the moratorium and the advice that goes along with the moratorium offering is actually made very clear to households, so they're very clear what they're getting into. And there was some sense of certain kinds of occupations, people in certain kinds of occupations actually availing the moratorium versus others not availing it. We saw, I thought this might be interesting, but at the bottom of the slide is really 4 types of repayment kind of post moratorium that we saw in the field. There's a good variety there, but we don't have a sense of what is the predominant kind of style or what is predominant type of moratorium that's being employed, right? And this has, so one is really EMI, you keep the EMI unchanged, but you increase the tenure. Otherwise, you keep the tenure unchanged, but you increase the EMI, or you use just the accumulated interest to pay as a single kind of payment, either immediately after moratorium, or you keep it till the end and pay it up at the last EMI. So there's a good variety of moratoria or other the repayment being the schedule being changed in order to accommodate the moratorium. And these are different implications for households. So I won't get into that. Next slide, please. Yeah, so rural and non-rural I kind of touched upon, but I think there was also this qualitative or other responses that we are getting that in the pure lending model, so in the JLG model itself, there are instances where the behavior of one individual could impact the other.
Hello.
Yes.
I think
I can hear you.
Yeah, there is some disturbance in the connection. Hello, Deepti, you're around? You there?
I think our connection is stalled.
Just wait for a few
I think
seconds.
there's a connection issue with Deepti probably.
Okay. Okay. Meanwhile, I think if it's not coming back, we'll quickly go over to Manoj. I'll first go to Dr. Gauri Shankar. I mean, if Deepti comes back, we'll continue, I think, with that. But just want a first impression, first overview of from an investor's perspective, how has been your treatment, and how have you seen the sector, and what are your mainly key things you have seen?
Thanks, Arun, Manoj, and Deepti, and the care team. Thanks for the opportunity. As I see the sector, basically, luckily, this is not the first time I'm seeing a issue in the microfinance sector, so that helps me take it in a really in a way that we have to take it as another event for the sector rather than just being just knee-jerk reactions. But we have been conservative. Basically, in March, we realized that this is going to be much larger than what we anticipated. So at least from Maanaveeya perspective, we stopped disbursement in the first week of March itself. That is something we have done. And I was actually, being a banker, a bit conservative on my approach to the MFIs. April was bad. But May, when I start speaking to the MFIs, the response was much positive than as I expected, basically. And June, July, basically, we have been waiting. And when I speak to them, at least 2-3 things very good happened, Arun. One, the agility of the MFIs. They have seen this type of troubles earlier, so they were a bit much mature than what I expected. That's very positive. That's one thing. The other thing is that government support came really on time. Basically, the TLTRO, the liquidity support, the push from the government, whether it's for Nabard or SIDBI to go ahead with lending. I think these steps really help to maintain the liquidity at MFI end. And after the moratorium, at least, for example, when mid the lockdown is over and some of the MFs really aren't supposed to go ahead with the clients and start engaging business, I think that should give a comfort that these people are on top of things. And also clients are really responsive. So basically, if I see the recovery percentages, as you rightly mentioned, in my client segment also, it is ranging from 20 to 70 from June, July onwards, which gave a very good comfort factor that yes, things are really moving in that direction. So from our perspective, we stuck with the clients. Sorry, Deepti, in case I will complete this one and maybe I will complete this question, Arun. So
yes,
from that's one thing we see positive. And at least being international organization, we have seen these types of things happening in other regions also in different times, Pogo, Nicaragua, and all those things. So we are a bit adaptive to this type of circumstances to change ourselves to be top of things, to be helpful to the MFIs and supporting them. So we are being more adaptive than local agencies. That helped us to be more as a bit anti-fragile. That's what I say. I think the other things that happened is that basically banks coming back. At least I could see two major investments happening in the last 3 months in spite of the pandemic. Basically, one is public domain information I can share. Basically, Gojo's investment in Satya, and then Maz investments in that Save Bihar MFI. I think these are really, I felt, turning points for the sector. That yes, in spite of all these things, the sector is good for the investors. And for example, just I want to give a balance that if all of you remember, after demonetization, where things were looking really bad, in March 2016 or 17, I think 17, ADB invested in Satin. So that gave a lot of boost to most of the MFIs and lenders to be going ahead with business. So all these things put together, I think things are looking much better than 3 months back as expected. I stop here, Arun, and maybe Deepti needs to complete so we can take it forward.
Yeah. Deepti, would you like to continue, or how much?
So, I mean, so I just had one more slide.
Like, yeah, sure. Okay. Yeah, can you go back, Ravi?
Yeah, that'll be great.
We lost your connection.
Yeah, I'm sorry, I don't know what's happening. Sorry about that. Yeah, no, so I think what we are interested in is really a couple of research questions along these themes. The moratorium, obviously, the question is, should we plan for another moratorium into the future, right? And it's really unprecedented. COVID is called the green swan, not even a black swan. And then, so should we be responding? What's the appropriate policy response? I think for us, we are interested in that question. Really, but from the point of view of pricing of the moratorium, the kinds of schedules that get set up in terms of repayment, customer protection, other angles to that, are there similarities to working capital loans? Because ultimately it's a working capital loan. You're actually borrowed at that particular price and at that borrowing rate for cost of funds for the institution. So what does that mean? Moratorium versus offering it as a working capital loan versus a moratorium. I think there are some similarities there, which some researchers have picked up. So that's something we're interested in. Collection efficiency, obviously we'll all keep an eye on that post moratorium to see, to check for the impact of moratorium as a policy tool itself. And of course, we are very interested in liabilities management for providers, right? This, along with a lot of the partial credit guarantee schemes, and I think there are 4 schemes in the Atmanirbhar scheme, in the announcement package itself, which has implications for both the assets and liability side of Nbfcs, including MFIs. So what does that mean? We've written about it, but then what does that, and how has that played out? I think it's of a lot of interest for us. And of course, implications for rating agencies as well as credit bureaus when it comes to how are you to even imagine the data that's going to come in, and how are you going to analyze that and ascribe your judgments on it. So that's actually. So I'll just wrap up there. I thank you so much for this coming back to me.
Thanks, Deepti, for your incisive one. It was really good to go into such detail, because one doesn't get to hear the ground reality. One talked about it. Of course, MFIs will have interactions with it, but these kind of concrete surveys gives you a lot of perspective. And thing you mentioned on the sense of distress, what is the extent of distress and what is the response by people, is a very interesting study. I'm sure our participants will have questions to ask. So I'll reserve those questions to them. So will continue with Dr. Gauri Shankar. You've said yes, there's a lot of interest. Even ADB is invested post demon, but now it is proved that it is a riskier segment. So given that it is riskier than other segments, do you see any do you see continuous support to the sector given its social impact, or will it be a deterrent? Will these events actually deter the investors from looking at this sector positively?
After spending so much time in microfinance sector, I don't agree with your statement itself, Arun. So I have to take that stand. Let me explain why. Basically, at least as far as this pandemic is concerned, this is across the sector agnostic. It cut across the segments, everybody. And for example, when we are looking at, say, AP crisis, demonetization, they were a bit more pronouncedly affecting the microfinance or small lending segments, but this pandemic across the board. From the perspective attributing some risks to the MFI sector because of the pandemic, because it's visible immediately, that's what I say, compared to others. My feeling is that the MFI sector will be hit hard immediately, and the lag effect is short. And maybe if the recovery starts, they will be the first sector to come back, bouncing back faster. And we can see this type of effect maybe slowly in the micro enterprises and SMEs and corporates later. My feeling is that we'll see this test in the larger segments in time to come, while we see the microfinance sector immediately. But the bounce back figure should be much faster. Having said that, and also seeing the way the microfinance institutions reacted or came back after the AP crisis or demonetization, I feel that yes, there could be some slowdown, some degrowth, some smaller MFIs may be affected badly. All those things might happen, which any business will happen. Having said, the well-managed, well-capitalized, good MFIs, I don't see there is any reason why we should shy away from them. And irrespective of these specific microfinance events, the sector has grown, banks have lent, investors have come. So that is the beauty of the sector. And again, as a banker, I can share that basically earlier banker, for a shorter duration loan of microfinance with the recovery percentages, certainly the yields are high. They can pay more, basically, whether the client to MFI or MFS to the banks. I think while there are some non-collateralized nature of the asset might have some challenges for lenders, but the counterweights for that one in the MFI segment is much higher than that one. So I don't see any reason. There could be, again, subject to statement is that there could be some delay, some slowdown. Some of the MFIs might be affected, but as a sector, I think it will come back, bounce back. And I still feel that the investors, both the equity and debt investors, will have reasonably good interest in this segment. Because as I speak to you, ours is ICO Credit. Basically, we are working with other international investors in the Europe, basically. Now they are talking about how do you say, basically they are coming with guidelines for the next investments in the microfinance segment. And the discussion today is how do you do the remote due diligence? Can you use a local agency to use the due diligence, or can you use a consultants to do that one? How to integrate risks into that one? So basically, these are the things they are discussing already. So from those things, I get the feeling that I think the sector is still support-worthy, attractive enough to go ahead.
Okay. That is very well-rounded kind of response. Now I'll just go to Mr. Manoj Nambiar. One, obviously, from an institutional perspective, one has to, obviously, when we look at our own rated clients, so two things which bother us are, obviously, this, in terms of the lockdown, what it has essentially done is, as against any other sector like housing or even other sectors where the period of the lockdown is not a significant portion of the time period of the loan itself. Here we are talking about a 3-month, 4-month lockdown versus a time period of 1 year. So it's a 40% of the entire 40-50% of the entire period. So it is a very significant event having this moratorium. So in terms of asset quality, what do you think is the asset quality and profitability? What is the impact of COVID and the lockdowns per se on MFIs?
Yeah, thanks, Arun. In fact, good to hear Gauri and Deepti and you talk about it. But let me just add a point to what Gauri said. See, in a country where 44% adult Indians have borrowed and only 8% have borrowed from an formally sort of regulated institution, right? You can understand with the 240,000 crore portfolio that the sector had end of March, it is still about 30% penetrated. So to that extent, the market size in the country, given our population, given our BOP segment, itself makes the sector very attractive for both investors and lenders. And I think the biggest difference which has happened post 2010 is the fact that the RBI regulations clearly have a new category called Nbfc MFIs. Lending, lenders have come back to the sector, and that's the reason why you see a sector of less than 10,000 crores in the worst period in 2011 has today reached about 240,000 crores and growing. Right? You're absolutely right that there are external situations which do impact the business, because this is a very vulnerable section of society that we are dealing with, whether it's a natural calamity on one side, or something like a demonetization which happened, or something like the COVID pandemic that we are seeing today. Obviously, it will have an impact, right? But I think the medium and long-term prospects remain absolutely intact, right? Given the shape and size of the the whole market that we are talking about. Like Gauri rightly said, and I keep explaining this to people, that it is delinquency which comes first, right? Provisions follow, and credit costs come later, right? So you have at least a 18 to 24 month kind of time frame in which you would see all these activities happening. So all of us, if you ask me today, are focused on the collection efficiency, focused on customer activation, if you ask me, right, from July till August. And then because September 1st is when the clock which stopped on the 1st of March is going to restart again, right? The aging essentially will restart from the 1st of September. So, and all of us do know, we've got our own risk management practices, our own credit units, which keep track of various events like demonetization, Cyclone Fani, Cyclone Amphan, floods which happen almost every year in different, different states in the country, including some major ones like, like we've had in sort of Kerala and all of that. And we know that the delinquency normally spikes up, right? It then over a period of time plateaus off and then flattens the curve. So the same thing will happen here also, right? Certainly in September and October, one would see a spike in delinquency, led primarily by the fact that not 100% of your customers are activated. And within that non-activated customers, there are certainly an X percentage, and which will vary from state to state, right? Whose livelihoods have not restarted, or they have not reached a level of activity which can help them manage themselves and also pay back the installments. Right? This is a business where you have to live and grow with the cash flow of the customer, right? So patience is very, very important here. It is not that in September everybody will come back to normalcy and you will have again 99.9% collection. It won't happen, right? So to react to your question, specific question, Arun, it is not a fact that most loans today are 1 year, right? Because if you look at the customer profile, yeah, having started at least I would say in an organized way from 2005 onwards, with again the regulation coming in place, and then Nbfc MFI is getting recognized and growing since 2012. You have a lot of customers who've gone through already the first cycle, second cycle, third cycle, fourth cycle, right? In fact, companies like us who've been in business for 13 years, we even have customers who've been with us for 7-8 cycles. Now, they are all recipients of loans of larger loan sizes, which obviously come with a longer tenure, right? So, so you have 12, 18, 24 months, normally on an unsecured lending, which is what this is, right? Normally one wouldn't give, sort of anything more than 24 months. So the lockdown in March end and the moratorium, phase 1 and phase 2, the extension going till end of August, certainly has created a certain disruption in the repayment, right? And it was conscious from the RBI to say, like Deepti also showed you in the survey, if your livelihoods have got impacted, if the cash flows are subdued, then how will you expect them to pay? So this is a relief which has been given, although it is not a free relief, there is a cost which comes along with that, which is the reason why you see in phase 2 of the moratorium, the number of people who've actually taken that are far lesser than phase 1. And in phase 1, I would say the reason why it has been more is because March was already over by the time the moratorium got announced. Right? 25th March is when the announcement happened. April pretty much went in a complete lockdown till 25th of April. Right? So both March and March, more or less people had paid. 75-80% collections had already been done. April was a month which I would say a lot of percentage of customers would have taken moratorium because nothing was moving. It was a complete lockdown. Last week of April onwards is when the unlock process started. And most of us, I would say by mid of May, we had our branches up and running, our staff coming back to the branches, and then activity restarting. But physical activity on the field has obviously been impacted given the various red, amber zones, green zones which had been notified, a great deal of local interpretation of the rules. Although from the industry sector level, we got the Ministry of Home Affairs to declare MFI as actually an essential service, like banks and BCs. So to that extent, we could actually, officially open our branches. Of course, there were restrictions in terms of the occupancy. There were restrictions in terms of going out to the field and doing the activity. But at least legitimately, you could open the offices back, right? So it's been a gradual process of continue to be connected with the customers on a virtual mode initially on the telephone, right? Literally trying to do a center meeting virtually so that the discipline which is there doesn't get lost in the month of April. And then slowly towards May, restarting whatever one could in terms of a very different kind of center meeting with social distancing, masks, sanitizers being used, right? And then that's how the momentum that you can see. So like my fellow panelists also mentioned, less than 10% collection efficiency in April, now reaching a level of about 70-75% in the month of July, which also could have been better, but for the fact that floods, rainfall, localized lockdowns. And please also understand, while a lot of us are today sitting and doing work from home, our field staff can't really do work from home, right? Their home is the branch. So they are all actually working in the field. So, our heart should go out to them to say, in this very difficult situation, sitting on a motorbike with your mask, sanitizing and keeping social distancing, they're collecting the money, meeting the customers, explaining the moratorium and collecting the money. So it's a great deal of effort which is going in, and we're all, as I said, hoping to improve the activation levels to the best situation possible by end of August, so that September is a more seamless movement from August to September, rather than that speed bump or that speed breaker that we see between August and September.
Just a couple of questions. One on this one-time restructuring of individual loans, which is now permitted.
Yes.
What is the likely impact on it? And secondly, just want to, you are mentioning about risk management, you're improving. So also from MFIN perspective, whether there has been a uniform standard code of thing which you have strengthened or which you have additionally imposed, some broad flavor, if you can give us, it will be very interesting.
Yeah, sure. So I would say, let me talk about the restructuring first. We are still going through the fine print because the RBI circular is quite technical in nature, and it cross references across 2-3 previous circulars as well. What I would say, the intent perspective is certainly to help customers whose livelihoods have got severely impacted at the bottom of the pyramid. So to that extent, both I would say the JLG loans that we give, plus some of us also do MSME lending, which is really the tiny and the micro enterprise kind of lending in terms of the sort of exposure. Both those segments certainly need help, and this is something that as an industry group we've also communicated to the RBI and the governor himself. So I think the intent certainly from the DFS and the RBI is to ensure that that facility is available. Now, what they have done, very rightfully so, is to say that that customer should have been standard as of 1st of March 2020. So you cannot use this for cleaning up some of the previous delinquencies which were there. Only those customers who were standard as of 1st of March and who, when after the September 1st opens up, then they have stress due to which they moved from that 30 to 60 and then 60 to 90 bucket. Before they hit an NPA roadblock at 90, they still have to be standard for you to invoke the restructuring. And what they're saying is that all this has to be done before December 2020, right? Whatever restructuring or whatever restatement that you want to do. They are saying that you can give a loan of up to 2 years, including the moratorium, including whatever extra charges have accrued in this period where, let's say, payments have not been done. And you can extend the tenure and take an extension of about two years. The idea being that a customer gets a longer time period to pay back, and also on monthly installments, which are far easily manageable rather than the higher installments that the person has to pay. But as I mentioned to you, the fine print is still being studied. We will also request the RBI to give us some clarifications, because all this has to be done essentially, I would say by October, right? Because once the opening up happens in September and the aging starts, then one would have limited time to actually activate that. On the industry getting together, and that's one of the reasons, Arun, I believe that compared to what happened in demonetization in 2016, where it was more of a sudden announcement, and the industry, frankly, at that point of time, like you said, a lot of the MFIs were actually moving into small finance banks. We had other changes in the sectoral landscape as well. The unity, I would say, was far lesser at that point of time. Today, we are getting into this and hopefully getting out of this particular issue with far more unity in the sector than what existed earlier. And why I say that is the Code for Responsible Lending, CRL as we call it, is an industry-wide initiative spanning across industry types. So you have banks, non-banks, we have for-profit, not-for-profit. Within the banks, you have small finance banks, universal banks, and within the NBFCs, you have NBFCs and NBFC MFIs. So 110 signees to the Code for Responsible Lending essentially is the strength that we are bringing to the table, and very simple 4 criteria which is being followed essentially for the customers for the members who signed up to basically adhere to. And what makes this even more special is that all of us are subjecting ourselves to a scrutiny every quarter in arrears. So one is, next time you meet or talk to a lender, please ask them, are you a responsible lender? First, have you signed up to the code? Do you have the responsible lender logo? And the second question should be, what is your score for the last quarter? Right? In these 2 questions will essentially tell you where that entity stands in terms of responsibility towards lending. Right? So every quarter we get a report out on the extent of adherence of that particular institution to these 4 parameters. And 4 parameters are not more than 3 lenders to a client, not more than 1.25 lakh outstanding, no lending without an updated credit bureau report, and no lending to an NPA client. And these are the 4 which we believe are the initial foundation blocks which will ensure that the sector grows on a foundation which is strong. In fact, this year we are planning to add 2 more measures. One is the 360-degree credit bureau report, so that you get a picture of the household rather than just giving a loan to the lady of the house, while the husband might actually be an NPA client, or or might have taken loans which the household is unable to pay. And second is also an employee database that we have created, so that mischievous employees are highlighted and do not find future employment in the sector.
Okay, I think it's a very critical thing because they handle cash on the ground after all. Because in spite of whatever risk management you will have, I mean, they are the link we need to have a very careful control on.
Although, Arun, I should tell you that today the disbursements are 100% cashless, and even in terms of repayments, I would say good MFIs who have invested and worked on this initiative well in advance are in excess of 50% on repayment, which is cashless.
Yeah. Nevertheless, the cash component has come down, but nevertheless, it cannot be eliminated totally.
Absolutely.
Yeah, I think we're running out of time. Before we go to Q&A, any quick, Deepti, you heard all of us. You also heard Dr. Gauri, Sankar, and Mr. Nambiar. So any final, do you say any final comments on?
Just I would like to, just one thing I want to add. Basically, it was very interesting for me to hear Muhammad Yunus in one of the seminars, webinars organized after the COVID, Arun. Basically, one of the MFs asked that basically the people who have moved out of migration back to villages, so what is the microfinance impact and recoveries and all those things. So basically, he told one thing which a bit stuck to me, which all of us appreciate, is that in Bangladesh, when floods came, actually these clients have gone back to homes in rural areas. But when the floods hit Bangladesh in the initial stage of microfinance, their houses were wiped out. And he told us that as long as MFI sticks with the client is going to pay. It's a matter of time. So I felt strongly about that one. So we felt that we'll stick with our clients, MFIs. I'm sure they will stick with the clients. And we are ready for some delinquencies and some delays. I want to add that much. Thank you.
Interesting. Yeah. The model itself is a very unique model which has worked very well and has seen such a level of collection which defy other logic like unsecured and you can't rely on it.
Yes.
You have a lot of control systems within. Yeah. Deepti?
Yeah. So this is something which I always said, which is that microfinance in India is actually can be a trailblazer when it comes to how do you engage with customers in a responsible manner, really, right? And I think a lot of the components of the responsible lending, the code for responsible lending is actually a personification of that. And I think some of the newer items that Mr. Manoj talked about, the whole 360-degree household level report, all of this is just things that we've always been asking for and advocating for. And I think many times I feel like just because you're working with, the sector is working with vulnerable populations, just getting this right can actually become a leader of sorts to other kind of lenders, like outside of the microfinance space. So this is really a big opportunity too, and it's great to know that institutions are going to continue and they want to continue to be by the side of customers, and that's actually going to be a something to look forward to and to uphold as a principle. So I really look forward to seeing how this is going to pan out, and the next few years are going to be pivotal.
Yeah, Arun, I'll just add 2 lines. One is, I think if India has to restart again, right, credit to the bottom of the pyramid is very, very important. And who else but us who can today impact 300 million lives across the 60 million end clients that we have? Through their families, we are impacting 300 million lives. So I think the government, the RBI, everybody else in the country understands that, and that is the reason why you find the liquidity measures, the support which is actually coming to ensure that money actually reaches there. Because if the economy has to restart, it has to start bottoms up. It can't be top down. Number one. Number two, I would say, as a rating agency, I'm sure you rate a lot of sectors, a lot of companies. Please tell me any other sector which grows in a normal steady state at about 30-40% per year, is able to give you collection efficiencies of 99% plus, credit costs of around 0.5% in a steady state, unless it gets impacted by any external event, right? Delivers an ROE of more than 15% and does social good in the process. I don't think there is any other industry in the country which can boast of doing that.
Yeah, all in one. Yeah. Now I think we'll move on to Q&A session. I'll pass this on to Mradul.
Yeah, thank you, sir. Yeah, thank you, sir. Dear participants, now we can begin a Q&A session. You are please requested to key in the questions, and the other option is you can click on the raise your hand option, and we'll unmute you. They can pose your query. Thank you. And I'll request my colleague Ravi Kumar Dasari also to take over the Q&A session.
Yeah, Dinesh Kaushik. Yeah, you can.
Hello.
Yeah, Dinesh Kaushik.
Hello.
You can please.
Yeah, am I
Please
audible?
introduce yourself. Yeah, please introduce yourself.
Yeah, my name is Dinesh Kaushik. I just want to check up with you guys in the sense that recently RBI had announced MFIs to raise ECBs. In the current scenario and without any exposure to the forex, without having a natural hedging, how does it work out for an MFI to borrow money in foreign currency, especially in these current scenario where things are so fluid across the globe?
Mr. Nambiar can take this.
No, so let me clarify that Nbfc MFIs in India are not allowed to take any foreign currency exposure. So whatever we borrow is all hedged 100%, and it has to be in Indian rupee denominated as far as our balance sheets are concerned. So which is normally one of the reasons why typically local borrowings have always tended to be more cost effective for us from a landed cost perspective. Because like some of you would know, Nbfc MFIs are tightly regulated even on the pricing. So our landed cost of funds plus 10 or 12% is what we can charge as the pricing. So there is no foreign exchange sort of exposure we take at all.
So you prefer to take a hedging across whenever you are?
It has to be hedged. On the balance sheet of the Nbfc MFI, it will be in Indian rupees.
Okay. Thank you.
And the next question is from Manish Goyal. Yeah, Manish.
A lot of lag actually. A lot of pauses there between questions. Yeah, Manish.
We'll move on to the.
Yeah.
We'll move on to the next participant. Neelam Divedi.
If you're not able to talk, I think we can take your, you can type out the questions.
Okay, next participant was raised hand is Pooja Eram.
I think there's a.
Okay, I'll read out the questions what we have got.
Yeah.
There's one from Murli Srinivas. He says, I think this question is to Deepti. They said, why is active data on one phone important?
Can you repeat what is active?
Yeah. So the active data pack, I think.
Is active data on one phone important? The parameter.
Yeah. No, I think that's a great question. Yeah. So I think that's a great question. I suppose the SPI team actually chose these 4 parameters as an immediate kind of we need, and really there are qualitative indicators, right, for distress, and these are the ones that they chose. But I wouldn't kind of dismiss it to say it's non-essential because at least from a peri-urban, urban, semi-urban scenario, this is increasingly becoming an important aspect. I mean, I don't have the exact numbers about kind of penetration of internet and all of that, but we do know very qualitatively that I would want to make sure I have internet on my phone. I mean, so anyway, so that's a judgment of from a sociological point of view, but I would say I think it's still important. It's just one of many indicators that we could use to see if people are spending on things that they usually spend, because there's always a trade-off, right? You have a limited, there's a constraint on how much money you have, and then what do you spend it on is an optimization problem that people are always facing. And then like what happens now when there is a lockdown?
Okay, thank you. There's one more question. I think this is from the investor side. They want to know. They're saying TLTR on other schemes. How many have got really benefited? Less than 500 crores company, less than BBB rating. Can anyone think that it's on paper? Even SIDBI and Mudra are selective. So Gauri sir or Manoj sir want to take on this?
I think I'll ask Gauri to go first.
Manoj, I don't have real data on this one, but having said, just what I want to tell you is that basically, if I see my own client segment, while my, let me say, it is 70-30 principle for me. So basically, maybe 30% of my clients who are above 500 crores might take 70% of the business, and 70% of my clients who are below 500 crores will take 30 to 40% of the business. Having said so, what I mean is that it's distributed. And certainly the rated clients have got better funding. But still what I could see is that, as Manoj mentioned, the moratorium basically, we have gone around 42 clients we have given in the first phase of moratorium. In the second phase, just 20 clients asked for the moratorium. So we could see the liquidity coming into their balance sheets. And certainly some of them are below 500 crore companies also. But sorry to state that I don't have specific data how many of them got in that category per se, but they did get. Manoj, I'll stop here.
Yeah, so the TLTRO stage 1 of 25,000 crores, essentially the subscription was hardly about 12,800 crores. And SIT India included both primary and secondary. The actual primary issuance would have been far lesser. But you're right that from the TLTRO, the beneficiaries have been primarily the medium and the large-sized MFIs, which had good ratings in terms of the credit rating which was there. But let me tell you, on the refinance program through both SIDBI and NABARD, while again you're right that the initial phase went to existing relationships, let me tell you, both NABARD and SIDBI have opened an extra window to even help cases or companies which they were under evaluation to fast track that particular process. So that was one thing which was done. Second was for the larger NBFC MFIs who are also lending to smaller MFIs, they have carved out and given an extra amount which was to be used for actually lending down the line. So for example, a company like Arohan, for the total amount that we got from NABARD, we got about 25 crores extra with the utilization being that it should go to smaller MFIs. See, small and medium will always have this issue, and all of us have started small. It's not that we became big day one. So the issue will always be in terms of your net worth size. It will be based on that your credit rating, and based on that the number of years that you've been in existence. So they will always need that help, which will come from, I would say, via media organizations like Nbfcs who've been active lenders to them. Some of us, the bigger NBFC MFIs, have been channelizing some funds to them, and also some of the organizations or the subsidiaries of NABARD, for example. Right, while NABARD has a certain cutoff in normal circumstances that they look at, today they are looking at even changing that. In fact, I don't know whether most of you have noticed that the latest announcement from the RBI also talks about a 5,000 crore limit, refinance limit, being given specifically to NABARD for 500 crore and below NBFCs and NBFC MFIs. So you can see the targeting which is happening towards helping the smaller MFIs and the NBFCs. The idea being that they should also get liquidity, because otherwise there will be a sort of repayment issue. So all these measures put together, I would say that money is trickling in. Certainly not like the larger MFIs who have access to the partial credit guarantee scheme, the refinance scheme and all of that. But we are ensuring that it does trickle down to the people who actually are performing well in terms of collections.
Thank you. Nidhi Chandra has asked this question. From an investor perspective, is it right time to enter, or we should wait for another 3 to 6 months to see the real performance test post-COVID? And
well,
she has continued with the question.
I would say in a sector like this, it is a good time to enter all the time. Right? It's just that the valuation expectations of the promoter, the price at which you can buy the asset, will actually change depending on what situation you are in. But in a sector like I said, where 30% is a penetration, and it's a very high priority on financial inclusion for the government, for the Reserve Bank of India, you can't go wrong. And a lot of things like KYC, digital transactions, credit bureau being strengthened, all of these are indicators as to how the sector will actually grow. You take the example of the last 10 years, right? In 2011, when we were at our weakest, we were less than 10,000 crores. Today, the sector is more than 240,000 crores. That has happened because of regulation, because of guidelines being defined, and which has led to investors coming in and investing, which is followed by lenders happy to lend. And good entrepreneurs, good companies, today you have 96 licensed NBFC MFIs in the country, of which at least I would say about 60 or 70 are actually active. This is the time to invest, if you ask me.
No, I just want to add here. I mean, don't you think this August 31st is the last day of the moratorium, technically speaking, and you are actually taking off the so-called band-aid post September 1st, when the real issue will come, whether you're going to pay, going to be something which people are going to watch. So,
Arun, what is happening?
From
What is happening now, if you ask me, is that because discussions around valuations will be inconclusive, right? Because the promoters will say, I am worth X. The investor will say, no, you're worth X by 2 or X by 3, right? Because of that, most of the transactions which are happening now are actually convertibles, right? So the promoter group and the company are saying that this is how we believe that the event will pan out. The investors are saying, fine, in that case, let us do a convertible. You pay us a certain coupon right now. You will convert the instrument, let's say in March 21 or March 22, once the entire impact of this has been factored in. And a lot of us who are on Ind AS are actually doing a estimated credit loss kind of provisioning. To that extent, the net worth is already getting adjusted, right? And anyway, in the next 3, 6, 12 months time, you will see the complete event unfolding, which will automatically have an impact on the net worth.
Okay.
So the following question was, do we see ADB support in this round for specific MFIs as it
Yes.
was witnessed earlier?
Yes, indeed. In fact, we are aware of an ADB intervention which is being coordinated by 2 agencies in India, and a lot of the banks who probably would be hesitant to move right now would be happy to move given the fact that there would be an ADB guarantee. ADB did that in 2011, 2012, and they have again come back with an intervention now.
There's one question to Nambiar sir again. I think, apart from personal and MSME loans, do you think that RBI will extend the loan restructuring facility to Nbfc MFIs as well?
Well, the restructuring is normally intended for the final beneficiary, not for the intermediaries in the middle. It's clearly ruled out even in the circular which has been issued. So I would say that's really where the net worth and the financial strength of the organization will actually play a part. As of now, no.
Okay. There's one question from Prashant Sridhar. He says, has there been any instances of political interferences to state that moratorium is a loan waiver in any specific geographies?
Well, you have a case at the Supreme Court today, which got, I think, bunged in by somebody who was a mortgage loan customer, who was basically said the same thing, that this is not a relief, but it is just a postponement of my obligation. And worse, it comes at a cost. Right. So initially the Supreme Court posted it for hearing and asked RBI and DFS to respond, which they have done, clearly indicating that if the interest is waived, it is almost 2 lakh crores, which is almost an X percentage of GDP, which is not possible. So then the focus shifted from the moratorium interest to whether compounding is happening and interest on interest will be charged. So that again, the court has actually put it on abeyance. Because both the other 2 parties wanted to come back with the exact percentage of customers who've opted for moratorium. Luckily, Ravi, this time the political class, I would say, have been far more responsible. I think there's far more greater understanding on the fact that it's a regulated sector by the RBI. RBI is the one which governs it and gives the guidelines for smooth operation. And I don't think in this kind of situation, anybody wants to create more confusion on the ground, right? So customers are now today much smarter. They understand the credit bureau is tracking all their payments or lack of payments, and that will certainly impact them in the next loan that they apply for.
Okay. One question, it is like MFI saw 4 to 5% credit cost after demon. Any guess estimate of the COVID-linked credit costs? Mr. Amit Mantri has asked.
Well, I can assure you, Amit, that the cost will be less than the last time. So let's see how things unfold from September 1st onwards.
There is question from Neelam Divedi. Can the panel shed a bit of light on urban microfinance picture?
So Gauri or Deepti, you want?
No, I request you to go ahead because no, just I can add. Basically, if I speak to my clients, I think whether it is generally what we are seeing, the rural economy is doing fine compared to urban economy, and even Deepti study says the same thing. And basically, food, agri, and rural sectors are doing well. From that perspective, I can see that the comfort of the MF when I speak to my partners. I think those focus on rural areas, more rural portfolio are certainly more confident than those a bit of urban focused MFIs, with some of them being affected by the migrant labor issues and all those things. So having said that, as I told you, it is too premature to decide because these people are under moratorium at this point of time and they expect the clients to come back. And so basically maybe September is the time I should know. But generally, the dipstick study, the indication, at least the feeling we get is that, yes, there is some, certainly a bit higher risk in urban microfinance at this point of time because of migration compared to rural one. But we haven't got any specific data that to share that one at this point of time. Manoj, if you want to take it.
No, I agree. So it's really that particularly in urban kind of microfinance clients, etc. Perhaps one observation is that markets were more dysfunctional than in the rural. and that has some implications, like what Mr. Boyshant was talking. The second observation was that rural or rather urban customers or these respondents were more likely to have digital currency, right? Like some abilities to do digital payments. So that may actually counteract and say, okay, fine, in the absence of cash, you could still do a lot of transactions were possible. Stop there.
No, clearly two things. One is that, like they have said, in the urban areas, the lockdowns have been far more severe, right, compared to what was happening in the semi-urban and the rural areas. So certainly the impact in the rural and the semi-urban had been lesser initially. But unfortunately, the urban migration, the reverse migration which happened, right, brought back some of the infection from the city into the semi-urban and the rural areas, and we've obviously seen that impact as well. The second key one is the fact that the agri connection in both the semi-urban and the rural areas has helped cash flow in the household. We've had a record harvest in the month of April when the harvesting season started. The sowing again has been significantly higher than what happens in the same period last year. So again, we are expecting another bumper harvest to come out. So, and I think the government support in terms of the MRP and ensuring that they're all getting picked up is ensuring that there is cash flow at the bottom of the pyramid, including some of the DBT transfers that Deepti spoke about, where a lot of the Jandan accounts, especially in the name of women, have actually got some amount of relief. I'm not saying it's a huge amount, but whatever comes extra is that extra buffer which is there. So certainly rural and semi-urban collections, I would say, have been better than urban.
Ravi, I think it's getting late. Probably last couple of questions. Ravi.
Yeah, okay, Sankar. There's a question from Sanjay Kumar. He says, what will be the lending strategy for the MFIs going forward? Will they increase the tenor to reduce the burden on the borrower, or will the ticket size of the borrower will go up to facilitate the present stress in the segment?
Yeah. No, 2-3 changes. One is that clearly in a post-COVID scenario, given what we've gone through, right, it is important now to segregate customers into 2 categories: new to credit and people who've already been tested through the group model, right? Certainly, I would say that people who are in their 4th cycle, 5th cycle, 6th cycle now want a low-touch model of engagement, right? So that they don't need to come and keep giving their attendance on a weekly, fortnightly, monthly meeting. Right? If there is a digital platform in place and if they're paying properly, why would you want to disturb them? Right? So clearly, I would see segregation there. On the tenures of loans, see, this is done based on the ticket size and based on the cash flows in the household. Today, even with existing regular customers, it doesn't mean that if your loan is finished, you would automatically get a renewal. What we are checking is whether the economic activity has restarted. So certainly there is a more inclination towards an 18-month and a 24-month loan, so that the monthly obligation there would be lesser than what you probably would have done in a sort of normal situation. So clearly that is being looked into. No, not too much of extra exposure is being given, because at the end of the day we are still waiting and sort of holding back to see what would be the real impact and how much time it would take for things to get back to normal. So a lot of emergency loans, I would say, like what the sector is quite famous for, when customers either go through a natural calamity or through a lockdown like this, right? Giving a emergency loan of 5,000 or 7.5 or 10,000 rupees, depending on where you are on the repayment cycle, as long as you've been a good customer, is something which the customer also requires today, because the household savings have been pretty much utilized in the lockdown and the slow unlock process. For them to get back to their livelihood activity and restart that, certainly need some amount of liquidity which is available. At some point of time, we had estimated at MFIN the sector would possibly need 10,000 crores of liquidity to look at emergency loans alone.
One more question from Madhavi. Question to Deepti. Was the sample size same across the rounds? And what was the time gap for each round? And whether any further studies planned?
So the sample size, I think we began with 347, and there was a reduction over the rounds. The last round was 257. So there was some attrition, and also there was also an optionality given that certain questions, if you're not comfortable, you can choose not to answer it. So there were certain questions where people actually chose not to answer. Also remember that, you know, it's the lending institutions enumerator going and doing some of these conversations in some cases. So therefore, yeah. In terms of what I understand is there are these 3 rounds and there is no plan to do another round, but there are other surveys happening and actually multiple other organizations also running. So I think, yeah, so, and I'm sure there'll be somebody out there who's going to do a kind of a meta-analysis of all of this, all of the research that's going to come out as a result of COVID and the lockdown. So, but as of now, this survey ends here. And there are other questions from the social security point of view, which are very relevant, and that's what the Social Protection Initiative is continuing to look into.
Okay, this is the last question we are taking in from Manish Goel. What will be the impact? It states that Bihar is extending lockdown after 31st August. So what will be the impact on CIBIL scores of such clients? And the second question is, are members who have taken loan after 2nd March are eligible for moratorium?
Good question. See, a lot of the states have extended the technical moratorium because that gives them a lot of, sorry, not the moratorium, the lockdown, because that gives them a lot of flexibility to handle the situation on the ground. But lockdowns today are not the lockdowns that we went through in the month of April when there was a complete lockdown, right? Lockdown, for example, in a state like West Bengal is specific days of the week, again, indicated sort of in advance. So you can plan your activities around it, whether you can do pre-collection or post-collection, right? So there is nothing like complete lockdown except in a very, very difficult containment zone. And even in containment zones, like we said, because digital repayment mechanisms are available today, people can still sit at home and do an internet banking transfer or using the payment gateways which are there in terms of making the payment. So I would say there is nothing like complete lockdown. Activity continues. Even in Bihar, where there are restrictions around the office occupancy and what physical activity you can do on the field. But every state today, if you ask me, from after July, has been trying to limp back to normalcy and give that positivity on the fact that businesses need to restart rather than being held back. But on the moratorium, the decision from RBI is very clear that it finishes as of end of August. There is no extension until something, God forbid, happens later.
Okay, I think
we are done with questions.
Yeah. Okay, Deepti, Dr. Gauri, Sankar, Manoj, Nambiar ji, it's a great pleasure for me to have you to have been a part of our panel and very good insights. I'm sure a lot of takeaways from here, from the entire perspective, MFI perspective, both from a MFI perspective as well as an institutional perspective and a regulation perspective. A lot of interest in the sector. I hope that this session would have been of a lot immense use to people who have attended. Thanks once again for attending.
Thanks.
Thank you, sir.
Thank you all. Manoj, Deepti, Arun, Ravi, thank you. Bye.
Thank you, sir. And thanks again to all the participants for taking the time out and being a part of this Care Ratings webinar. For any further queries, feedback or suggestions, you can please respond in the feedback mail, which will be coming no sooner the webinar ends. Thank you and goodbye for now.
Thank you.
Thank you.